The stock market today feels like a giant coin toss. AI is trading faster than the speed of light, crypto swings like a roller coaster, and the news changes every single hour. And if you feel like you can't predict what's going to happen next, congratulations. You're finally seeing the world the way it really works. More than 50 years ago, Burton Malkiel, an economics professor at Princeton, said the same thing in his classic book, A Random Walk Down Wall Street. He made a statement that many people on Wall Street absolutely hated to hear. Even a blindfolded monkey throwing darts at a list of stocks could beat most professional investors. Why? Because the market is random, and almost no one can consistently outperform it in the long run. Not because you're not smart enough, but because you're playing a game where all the information is already priced in, long before you even read about it in the news. This book doesn't teach you how to predict the future. It teaches you how to survive and even win in a world that's unpredictable through logic, discipline, and time. If you've ever felt lost among 1,000 get-rich-quick strategies, or if Wall Street seems like a casino only the lucky ones win, stay until the end of this video, because a random walk down Wall Street will show you that success in investing doesn't come from being smarter than others. It comes from being more patient than everyone else. And don't forget to hit like, subscribe, and join me in the next book summary, so together we can reach true financial freedom. Part 1. The market is random, and no one can predict its direction. Burton Malkiel opens his book with a shocking idea. Stock prices don't follow any predictable pattern. They move like a drunken man taking a walk. You can't tell whether his next step will be to the left or to the right. From that, he introduces the concept of a random walk, a random stroll down Wall Street. It means that every piece of information, every expectation, every bit of news, whether good or bad, is instantly reflected in stock prices. No one, not even top analysts or billion-dollar hedge funds, can consistently predict where the market will go next. Sounds pessimistic? Not really, because that very randomness is what creates fairness in investing. You, an ordinary investor with a small account, still have a chance to win if you truly understand the nature of the game. Think back to 2021, when the GameStop and AMC frenzy shook Wall Street. Retail investors on Reddit managed to beat big hedge funds, sending stock prices soaring by dozens of times in just a few days. But only weeks later, most of them lost all their profits. Not because they were stupid, but because they confused luck with skill, the emotional waves of the crowd with the real value of the market. The same thing is happening today with crypto, AI stocks, and meme coins in 2025. A single tweet, a viral TikTok video, or one speech from the Fed can send the entire market skyrocketing or crashing within hours. People think they're reading the market, when in truth, they're just surfing on randomness. Malkiel wants you to understand one simple truth. No one can predict the future. Even Warren Buffett doesn't know whether Apple stock will go up or down next week. What he does know is the intrinsic value of a company and the power of patience. The market doesn't reward those who are the fastest or the smartest. It rewards those who are steady, who know what they're doing, and who accept randomness as a natural part of the game. As Malkiel wrote, "There is no map for a random road, but there is a compass. And that compass is the right mindset."
Part 2. Bubbles and the Illusion of Investing. Burton Malkiel once said, "Every generation believes it has found a new way to get rich faster, and every generation ends up learning the same old lesson again." To him, the history of finance is an endless cycle of bubbles, where greed, fear, and illusion take turns steering human behavior. Look back over the past few centuries. In 1637, Europe went crazy over tulips. The price of a single bulb could buy a house in Amsterdam. Hundreds of years later, we repeated the same mistake, only under new names. In 1999, it was the dot-com bubble. In 2008, the housing crisis. In 2021, the crypto and meme stock frenzy. Malkiel called this rational madness. Because deep down, everyone knows the risk is there, yet they still jump in, terrified of missing out. What makes bubbles dangerous isn't how fast prices rise, it's the crowd psychology behind them. When everyone around you is talking about a certain stock, coin, or can't-lose ETF, your brain starts whispering, maybe this time is different. But as Malkiel showed through centuries of data, it never is. Bubbles always inflate on hope and burst on reality. The only thing that changes is the name we give them. In the world of 2025, technology makes bubbles form faster than ever. AI trading, social media, and finance influencers have turned investing into a stage for collective emotion. A single TikTok video with the hashtag #GetRichQuick can send millions of people chasing the same penny stock or some unknown token. Today, the market doesn't just move on data, it moves on views. But as Malkiel reminds us, technology doesn't change human nature. Greed, fear, and FOMO remain the three most powerful engines of loss. Malkiel once wrote, "No one knows when a bubble will burst, but anyone can tell when they're inside one, if they're honest with themselves." That's the lesson he wanted every investor to remember. Ask yourself, is the value you're buying based on real earnings or just on the hope that someone else will pay more later? When your answer leans toward the latter, it's time to stop. In the end, he reminds us that wise investors don't chase the noise of the market. They step back, observe, and wait patiently for real opportunities. Because while the crowd is busy trying to beat Wall Street, those who truly understand randomness focus on just one thing: not getting caught in the illusion. Part 3. Stocks remain the most profitable asset in the long run. If there's one thing Burton Malkiel believes with absolute conviction after more than half a century of watching the markets, it's this: no investment vehicle outperforms stocks over the long term. Through wars, crises, recessions, and bubbles, stocks have consistently been the safest ticket to beat inflation and build real wealth. Just look at the past 100 years of American history. Since 1928, the U.S. stock market, represented by the S&P 500, has delivered an average annual return of around 9 to 10%, despite the Great Depression of 1929, World War II, the dot-com bubble, the 2008 financial crisis, and even the COVID crash of 2020. Malkiel compared stocks to a roller coaster. They can make you dizzy in the short term, but the wheels are always tilted upward in the long run. Investors who understand this don't panic when prices fall, because they know the market never stays down forever. After every crash, America always rebounds stronger. Technology advances, productivity rises, businesses innovate. And that constant innovation is what drives stock prices higher, decade after decade. Malkiel often illustrated this with a simple example. If you had invested $10,000 in the S&P 500 back in 1970 and simply left it there until 2025, your portfolio today would be worth over $2 million, even after living through every major market crash. But if you had tried to time the market, jumping in and out to avoid downturns, missing just the 10 best days of returns would have cut your profits almost in half. The market rewards patience, not short-term cleverness. Today, many Americans are drawn to new types of investments, from crypto to tech startups, from AI stocks to meme stocks. But Malkiel reminds us the core principles of investing never go out of style. A diversified, low-cost portfolio focused on long-term equities remains the simplest and most reliable path to real wealth. He calls this journey a random walk, because you can't know where stock prices will go tomorrow. But if you keep walking long enough, that path almost always leads upward. And that's the quiet magic of stocks. Their power doesn't lie in sudden leaps, but in the steady compounding of time.
Part 4. Why most investors lose money. Burton Malkiel once said, "The market isn't unfair. It simply punishes those who don't understand how it works." That simple statement explains why most investors, despite good intentions, still end up losing to the market. Not because they're not smart, but because they're too human. Imagine it's 2020. The market has just crashed due to the pandemic. Every headline screams panic. The economy is collapsing, stocks in free fall. Terrified, many people rush to sell everything, believing they are, quote, protecting their assets. 6 months later, the market rebounds sharply, and they watch from the sidelines, regretful, confused, until they jump back in at much higher prices. That cycle of emotion is what Malkiel calls the behavioral paradox. People tend to buy when they feel safe and sell when they feel scared, which is exactly the opposite of what they should do. But emotion isn't the only problem. Malkiel also points to another common disease, the illusion of control. Most investors believe they can pick stocks better than average or time the market to catch the, quote, top and bottom. But decades of research prove otherwise. Over 90% of actively managed funds fail to outperform the market index in the long run. Even the most skilled managers are eventually beaten by randomness, the market's built-in unpredictability. One famous example is the Dalbar study, an annual report tracking the performance of U.S. investors. Over a 30-year period, the S&P 500 returned an average of over 9% per year, yet the average individual investor earned only 3 to 4%, not because of fees or taxes, but because of bad timing. They were fearful when they should have been patient and greedy when they should have been cautious. Malkiel says to win, you don't need to be smarter than Wall Street. You just need to be calmer, because the market is simply a place where money moves from the impatient to the patient. And in the world of investing, the winners aren't those who predict the future, but those who can endure the present. Look at the great examples: Warren Buffett, Jack Bogle, and others. They never tried to beat the market. They stayed disciplined, bought quality assets, and let time do the heavy lifting. That's why they became wealthy, not because they were lucky, but because they mastered themselves. Part 5. The Solution: Index Funds and Diversification. Burton Malkiel once said, "If you can't predict the future, own the whole future." That's the philosophy behind index funds, a simple yet powerful solution that outperforms most of Wall Street's complex strategies. Think of it this way: instead of trying to pick a single, quote, winning stock, you buy the entire market, like betting not on one horse, but on the whole racetrack. When some companies fail, others rise to take their place, and the index keeps climbing. Over time, you don't have to be right, you just have to stay invested long enough. Malkiel revealed a fact that many investors still find hard to believe. A low-cost index fund that mirrors the S&P 500 typically outperforms 80 to 90% of actively managed funds in the long run. The reason is simple: lower fees, fewer mistakes, and smaller tax drag. When you're not paying hefty management fees every year, your money keeps compounding, creating that exponential growth Albert Einstein famously called the eighth wonder of the world. Here's a simple illustration. Two investors, Alex and Jamie, start at the same time. Alex invests in an active fund with a 1.5% annual management fee. Jamie chooses an S&P 500 index fund with just a 0.05% fee. After 30 years, with the same initial investment and the same market returns, Jamie ends up with over 25% more wealth than Alex, simply because she didn't let fees quietly eat away at her gains. And it's not just about stock indexes. Malkiel emphasizes the importance of global diversification, mixing U.S. and international equities, bonds, REITs, and even non-traditional assets. By spreading across different asset classes, you don't just reduce risk, you stabilize returns. He compares diversification to not putting all your eggs in one basket, but also warns it's useless to have many baskets if they're all in the same truck heading downhill.
True diversification means owning different types of assets, not just funds with different names. It's just like in life. You can't control every event, but you can build a strong structure that stands firm through any storm. And in investing, that structure is made of 3 pillars: low-cost index funds, diversified allocation across time, regions, and asset classes, and long-term discipline. Malkiel isn't asking you to gamble. He's showing you that you don't need to beat Wall Street's game at all, because you can win, not through genius, but through consistency and simplicity.
Part 6. Smart Asset Allocation Through Every Stage of Life. Burton Malkiel once said, "There's no single investment strategy that's right forever, only the one that fits your stage of life." To him, investing isn't about chasing the highest returns at any cost. It's about finding the right balance between risk and peace of mind. Let's start with someone young, say Ethan, 25 years old, fresh out of college. His income might still be modest, but he owns something that even billionaires can't buy: time. Malkiel reminds us that at this age, short-term risk doesn't matter. The real danger is being afraid to take any risk at all. That's why a young investor's portfolio should lean heavily towards stocks, especially broad-based index funds like the total market or S&P 500. In a few years, prices might fluctuate wildly, but over a few decades, history has proven that stocks always win. As you move into your 40s and 50s, priorities shift. Now it's less about building wealth from scratch and more about protecting what you've earned. You may have a family, children, and bigger financial responsibilities. Malkiel suggests gradually increasing exposure to bonds and other stable assets, not because you've become more fearful, but because you're getting closer to a point in life where you can't easily start over. At this stage, wisdom means balance. Keep enough stocks to let your money keep growing, but enough bonds to anchor your portfolio when markets shake. And by the time you reach your 60s and beyond, when retirement is no longer a distant idea, Malkiel advises focusing on preservation and sustainable withdrawals. But he also warns against pulling out of the market entirely. Even at 70, people may live another 20 to 30 years, and inflation remains a silent enemy. That's why he offers a simple but time-tested rule of thumb. Stock allocation equals 100 minus your age. So at age 60, you might hold 40% in stocks and 60% in bonds, a balanced approach that is held up through countless economic cycles. He also recommends target date funds, which automatically adjust your asset mix as you age, giving ordinary investors a professional-grade strategy without the complexity of constant rebalancing. For those with larger portfolios, adding REITs, international stocks, and inflation-protected bonds, or TIPS, can further strengthen and stabilize returns in any market environment. What Malkiel wants us to understand is this: investing isn't just about numbers, it's about walking alongside life itself. Youth is the season for planting seeds, midlife is for nurturing and protecting them, and retirement is the harvest. But even then, you must keep a few seeds for the future. Because, like the market, life never stands still. Those who know how to allocate wisely don't just maximize returns, they buy something far more valuable: peace of mind and financial freedom through every chapter of life. Part 7. The warning about new myths, technology, AI, and crypto. When A Random Walk Down Wall Street was first published in 1973, the internet didn't even exist yet. But interestingly, Burton Malkiel had already predicted something that remains true more than half a century later. Every generation believes it has found a shortcut to wealth, but in the end, the only real path is patience. In the 1990s, American investors were swept up in the dot-com frenzy. People poured money into any company with .com in its name, convinced that the internet would change everything. And yes, the internet did change the world, just not for everyone. When the bubble burst, the Nasdaq plunged nearly 80%, and millions of investors were wiped out. 2 decades later, history repeated itself, just with new names: AI, crypto, NFTs, the metaverse. The stories sound different, but human psychology stays exactly the same. Malkiel called this phenomenon the new myth, the collective illusion where crowds convince themselves that this time is different. And once again, greed takes the wheel while reason gets left behind. Think back to 2021, when Bitcoin soared past $60,000. YouTube channels, podcasts, and Twitter, now X, were flooded with voices proclaiming this is the future of finance. Many Americans mortgaged their homes, emptied retirement accounts, and rushed to get in before it's too late. But just a year later, after the collapses of FTX, Celsius, and Luna, that dream crumbled. Malkiel never opposed technology. He once said, "Technology can change the world, but it cannot change human nature." In other words, investing in AI or blockchain isn't wrong. It only becomes dangerous when you chase price instead of value. He urged investors to distinguish between real innovation and crowd-driven speculation. If you believe in the future of AI, invest through index funds that include real, profitable innovators like NVIDIA, Microsoft, and Alphabet, not random tokens with no fundamentals. If you believe in crypto, treat it as a small, diversified position, not an all-or-nothing gamble. And if you ever feel that fear of missing out creeping in, remember, the market will always give you a second chance as long as you still have both money and reason. After more than 50 years, Malkiel's message hasn't aged a bit. Technology changes fast, but the laws of greed and fear never do. Don't become a victim of a new myth wrapped in the language of modern innovation. Because in the end, the random walk he spoke of wasn't about the market's luck, it was about a timeless truth. No one knows the future, but the disciplined will always outlast the dreamers. Closing, a timeless lesson. For more than half a century, a random walk down Wall Street has remained a survival guide for every investor, not because it teaches you how to get rich quickly, but because it teaches you how not to destroy yourself on the road to wealth. Burton Malkiel once said, "Investing isn't a race against other people, it's a journey where you learn to master yourself." In this age of AI, crypto, and constant technological hype, the hardest thing isn't finding the next winning stock, it's keeping your sanity when everyone else is losing theirs. Because in the end, true wealth doesn't come from predicting the market, it comes from understanding yourself. If you feel these ideas still matter and a world is changing faster than ever, then hit like, subscribe, and join me for the next video. Sometimes all it takes is one right idea, understood deeply and applied with discipline, to completely change the trajectory of your financial life.